Hi, this is Francesco Negari, Deloitte Global IFRS Insurance Leader. Welcome to our May 2018 IFRS Insurance Webcast. Today we are covering the outcomes of the second Transition Resource Group meeting, which took place last week in London at the ISB office. The agenda for today's webcast will kick off with an introduction to refresh our memories on the purpose that the ISB TRG serves, and then we'll spend the lion's share of today's webcast, which will last approximately 45 minutes, to talk about the background of the TRG papers that were tabled for discussion and what was the outcome of the discussion last Wednesday. I'll conclude the webcast by looking at the next steps the ISB intends to take following the discussion with the TRG. As you probably know, but let me just remind you, the TRG was established late last year with the purpose of inviting discussion and analysis of potential stakeholder issues arising from the implementation of IFRS 17. 15 members have been appointed, 9 from the preparers community across multiple geographies, and 6 from the large professional services networks. I am one of those 6 professional services network representatives. The second goal is to provide a public forum for stakeholders to learn about the new requirements, and this is done by making the TRG meetings public. You can register to observe the discussion, either by being present physically in the office of the ISB in London, or connecting via the web link that broadcasts live the TRG meetings every time they are held. The last goal is to help the ISB determine whether additional action is needed to support the implementation of IFRS 17, such as providing clarification or issuing other guidance. And that can go as far as proposing an amendment to IFRS 17. Interestingly, in the second TRG, this is one of the outcomes that we have reported. We have a proposal from the ISB staff to amend IFRS 17 with regards to the topic that actually dominated the discussion last week. That topic was the measurement of coverage units, which is the driver for the recognition of IFRS profit in the financial statements, effectively the release of the contractual service margin, which is the deferred profit liability component that is created at the initial recognition date. Let me kick off from this paper. This was agenda paper 5 in the series of papers that were tabled for discussion last week. And the background for the paper is that under IFRS 17, there is a requirement to estimate the total coverage units and their allocation to each part of the coverage period. That is necessary in order to depict the transfer of the insurance service to the policyholder, the insurance contract customer. To determine the release of the contractual service margin during the period and to affect the recognition of profit, the insurance revenue and profit, the standard requires to calculate a quantity of service, a quantity of benefit, and that is referred to as a coverage unit. These are calculated for the whole group of insurance contracts, which you remember is a portion of a portfolio of insurance contracts no more than 12 months from the first to the last contract in terms of issue date. And all the contracts in this particular group fall within one of the possible profitability buckets. And just to remind you, the only 2 buckets with a CSM are the ones that are profitable with a chance of becoming onerous at some point in the future, and the other profitable contracts. The third bucket doesn't have a CSM and doesn't have coverage units, at least at the point of initial recognition. That is the group of onerous contracts. The key question here, therefore, is to calculate the total number of coverage units and to establish how to read the quantity of benefits provided and the expected duration of coverage over which those units will be earned. This is not the first time the coverage units are debated by the TRG. Already in the first meeting in February, there were submissions and an agenda paper that covered some of the initial observations from the ISB staff and the TRG members. The 2 most important observations are summarized on the slide. The first one is that coverage units reflect the likelihood of insured events occurring only to the extent that this affects the expected durations of the contracts. In other words, you may have more coverage units if the service period, i.e. the coverage period, is longer, or less if it is shorter than the previous measurement date. Coverage periods are reassessed at each reporting date in compliance with the current measurement principles of IFRS 17. Coverage units do not reflect the probability of insured events occurring to the extent that those probabilities affect the expected claims amounts. And that is to separate the recognition of revenue and profit from the CSM release from the expenses and experience variances that arise from the release of the fulfillment cash flows estimates against the actual payouts and collections. The key question that was debated in this paper is, what is the definition of quantity of benefits under the key paragraph in IFRS 17, B119? The staff analyzed the problem by subdividing the universe of insurance contracts in two subsets. The first one is the insurance contracts without investment components. These are what we could call pure risk contracts, where there is no obligation to pay cash other than under the occurrence of an insured event. If no insured event occurs by the date the contract expires, no cash is paid. And the 5 key points that I wish to draw to your attention are, first of all, a reminder from the ISB staff that the sources of profit from IFRS 17 are more than just the CSM release. The CSM release clearly is perhaps the most important one, but sources of profit include also the release of the risk adjustment for non-financial risk and the positive or negative impact of experience adjustments on the expected outflows. The second point is that the period during which an entity bears insurance is not necessarily equal to the insurance coverage period, and that's something to bear in mind in terms of the expectation of the coverage period estimation. If you think about the claims handling period, that takes place after the expiry of the coverage period, but still leaves the insurance company exposed to insurance risk. The third point is that when contracts in the group provide different types, amounts of insurance benefits, there is a need for a method to account for such diversity and how the benefits change over the term of the coverage period. This means that the number of coverage units is also reassessed at each reporting date, taking into account the method that reflects the variability of possible benefits and the variability of the coverage period. The fourth point made in the paper is that because of the impact on the coverage period the lapse assumptions will have, they must be considered in determining the coverage units, because they are instrumental in determining how long or short the coverage period would be. And finally, the ISB staff explained that the estimation of coverage units is not an accounting policy, but involves judgment in determining the provision of service in a systematic and rational way. In other words, we are faced with a requirement supported by a principle enshrined within paragraph B119, but the application of that principle could be calling for a significant amount of judgment. The staff paper continues by looking at the principles that should be used in measuring the quantity of benefits for insurance contracts without investment components. And they note a couple of things. The first one is that an amount of CSM has to be recognized in profit or loss in each period when the insurance coverage services are provided by contracts in the group. That is also to reinforce the point made earlier that the release of CSM is not dependent on the expected payout from the contract. The rationale behind that is the benefit is provided even when the entity stands ready to pay for claims, but no expectation of claims to occur is applicable to that particular period. With all these principles in mind, the ISB staff laid out a couple of principles a couple of methods that could be used to estimate the quantity of benefits. The first one is the maximum amount of cover available in each period, effectively a study of the contractual benefits and identification of what the maximum benefits would be available in each of the periods. An alternative to that would be a method that looks at the amount the entity expects the policyholder to be able to validly claim in each period. During the discussion on this point, I observed that the second point can actually be generalized further by saying that is the maximum expected amount of claims a policyholder can valuably report in each period. And the first method could become redundant in the definition, and it appears to me that this could be a more universal principle that could be used to explain the paragraph B119 principle. The IASB staff also indicated 4 methods that were deemed to be inconsistent with the principle in B119. The first one is a method that calculates the release of coverage units and the quantification of benefits using the performance of the entity's assets. Bearing in mind that this is discussing the subset of insurance contracts without investment components, it's only logical that this principle is established. Entities' assets would be held to back the insurance liabilities, but they don't influence their cash flows. The second point is regarding a method that results in no allocation of CSM to periods where the entity is standing ready to meet a valid claim. Also, a method that calculates coverage units and they are released to P&L in this way will not meet the principle of B119. The IASB staff then talks about 2 additional methods which are not deemed to be appropriate, but does so by introducing a rebuttable presumption that could actually make them viable. These are methods based respectively on premiums and expected cash flows. They are deemed to be inappropriate because they reflect cash collection in the first instance and expected payout in the second instance. However, the rebuttable presumption is that if an insurer can demonstrate that these are a reasonable proxy for the services being provided by the entity in each period, then they will be allowed to calculate the coverage units and they are released to profit or loss over the periods. The staff then analyzed the second half of the universe of insurance contracts. These are the insurance contracts with investment components, and made a number of important points. These are the points that eventually led the IASB staff to propose an amendment to IFRS 17. The first point is that the main consideration in this particular subset of insurance contracts is whether any coverage units should be allocated to the provision of investment service or not. In the view of the IASB staff, that answer must be answered positively for the variable fee approach contracts. These are contracts that provide both insurance and an investment-related service, given that the CSM recognition and the currency units should reflect the provision of both services. On the contrary, insurance contracts with investment components that are not VFA contracts would be deemed to offer only one type of service, the insurance service, and would not include the investment service in the calculation of the coverage units, making therefore the computation of the benefits from the contract one that is excluding the investment components. The analysis of the IASB staff concluded that because of the ambiguity of the wording on the coverage period, they decided to propose to the board later this month an exposure draft that will amend IFRS 17 and introduce a new definition of coverage period for variable fee approach contracts, requiring that the coverage units for those contracts include both insurance service and investment-related services. The debate that followed was lively and quite protracted. In fact, I'd like to remind you, this was the lion's share of the time we spent together last week at the TRG. The first point is that all TRG members were of the view that the principles produced in the staff paper were useful in identifying the quantity of benefits provided by the variety of contracts which were simplified. The number of examples is quite extensive. The number of pages of the paper is quite long. We're talking about over 40 pages of discussion and examples. And if you have a particularly pressing need to understand more about the coverage unit issue, I would strongly recommend to read that paper. However, the richness of this example also caused a degree of concern, and some TRG members noted that with so many examples based on very fact-specific sets of circumstances, there was a risk that people may fall foul in extrapolating from these examples the principles in IFRS 17. and apply them incorrectly for slightly different scenarios. I personally made a comment that I was not as concerned as other colleagues from the TRG on that point, and I consider that if the principles were sound and clearly articulated in the standard, examples will only corroborate and reinforce the understanding of the principles and their application in a consistent manner. Other points the TRG members made were with regards to the number of methods which were deemed to be appropriate and inappropriate. We commented on the fact that that appeared to be too narrow and suggested a closed number of methods rather than offering a set of principles that would then be used to develop the appropriate methods along the benefits offered under the different types of insurance contracts. There was an acknowledgement, however, that the method of estimation of the quantity of benefits provided by the contract is not a choice, and different methods may be appropriate depending on the relevant facts and circumstances. With regards to the decision to refer the matter to the ISB for the VFA contracts and the provision of investment services, there was support from all of the TRG members present. However, several TRG members, including myself, did not agree with the ISB staff that these amendments should be restricted to variable fee approach contracts only. And we observe that there are several other insurance contracts with investment components accounted for under the general model, also known as indirect participating contracts, that provide substantial investment services, and those services are a significant material component of the CSM balance. I, together with other members of the TRG, were concerned with the possibility that if this amendment goes through as proposed, we will face then a different treatment between the VFA and non-VFA indirect participating contracts when there are economically similar service obligations provided by both types of contracts. This point will be presented to the board for discussion as early as this month. The agenda for this month board meeting is not yet out, so we'll stand by to see whether this will be the case. The second issue that I wanted to report back to you is on the determination of the risk adjustment for non-financial risk. The issue here comes from the application of paragraph 37 that sets out the principle the risk adjustment must be calculated as the compensation the entity requires for bearing uncertainty about the amounts and timing of cash flows arising from non-financial risk in the contracts that it has issued. The compensation also reflects the degree of diversification benefits that the entity includes when calculating such compensation, and the submission asks whether the level of aggregation that may exist at individual financial statements level and at consolidated financial statements level could create the possibility of different amounts of risk adjustment being calculated in compliance with the same principles of paragraph 37. The ISB staff analysis of the guidance is that there should be only one risk adjustment, and this amount reflects the single decision that is made by the entity that is party to the contract. This means that it is the individual financial statements calculation of the risk adjustment which determines the balance that will then be aggregated in the consolidated financial statements. However, the ISB staff also clarified that when the entity calculates the compensation, there is no restriction on the sources of input that will be considered to determine the compensation levels. And if the entity takes into account sources of diversification that are outside its perimeter, for example, the negative correlation that a portfolio of insurance contracts issued by the particular entity may have with the portfolio of another fellow subsidiary, that factor is a legitimate factor that can be reflected by that entity as an input in the compensation required by the entity for bearing the uncertainty of the insurance contracts. Obviously, the conclusion of a single risk adjustment produces an operational advantage for particularly life insurers, given that a single risk adjustment makes the calculations required in IFRS 17 to be computed only once. In the event that the risk adjustment had two different levels, at individual financial statements level and at consolidated financial statements level, all the calculations in IFRS 17 would have been performed twice, with significantly larger amount of computational power necessary to comply with the requirements. TRG members agreed that the determination of risk adjustment is not an accounting policy, but it reflects the actual compensation the entity requires for bearing uncertainty. There was a split, however, among the TRG members as to whether the amount the entity would charge, quoting from paragraph B87, refers to the pricing of insurance contracts, a concept which was favored by a number of the ISB staff and board members present, or the issuer's cost for uncertainty, a concept that I actually favored and many other members of the TRG favored. This is important because whether the risk adjustment relates to a single decision made at the point of pricing or as a continuous assessment of the cost of risk or the cost of uncertainty can actually create different practical implementations, decisions. I believe that eventually the ISB staff took notice of the second view of the word charge, and we are now standing by to see the official record of the outcomes of the meeting to observe how this particular point has been portrayed. There was also another aspect TRG members raised, and that is the focus on the point of compensation the entity requires, which may be evidenced by the capital required or to be carried instead of the premium charge. TRG members that focus on that particular aspect of the requirements observe that this would appear to be another argument in favor of interpreting the word charge as a cost of risk rather than the reflection of the pricing of the insurance risk in the contract. TRG members were also split on another aspect regarding the level at which the risk adjustment for non-financial risk is determined in the consolidated financial statements. Many TRG members expressed their preference for a more flexible approach and were uncomfortable with the staff view that for the same group of insurance contracts, the risk adjustment is always the same, regardless of the level of consolidation of financial reporting purposes. These expressions of alternative preference for the conclusion the ISB staff documented in their paper came particularly from those preparers, TRG members, who have substantial P&C business. If you think carefully about the practical implication of this decision, the consequences of a single risk adjustment are of very limited operational relevance to general insurance companies, P&C companies, who are primarily adopting the premium allocation approach for the liability for remaining coverage. And the majority of the risk adjustment calculations and measurement are associated with the liability for incurred claims. In the context of those business lines, we also have seen through a number of impact assessments that Deloitte has done over the years that the materiality of the amount of the risk adjustment is superior, is larger than what you would get against the fulfillment cash flows in the life insurance sector. And therefore, the allowance for a reduction of the risk adjustment, when consolidation of individual portfolios at subsidiary level is carried out, could be seen as a relevant practice. During the TRG discussion, reference was made to the Australian market under current IFRS, where the risk adjustment is already reported at two different levels for group and individual financial statements purposes. In that context, it was clear that TRG members were reading differently the reference to the word entity in the definition. And although we were able to agree on the words charge and compensation, that remained a point of difference conclusion, where a number of TRG members looked at the word entity as meaning the reporting entity, therefore meaning the individual reporting entity and the consolidated reporting entity, potentially producing different perspectives and different compensations for the uncertainty of the underlying cash flows, and others looking more in line with the ISB staff as the issuing entity party to the contract, leading to a conclusion that the ISB staff was correct in identifying the application of IFRS 17 as producing one single risk adjustment. The next topic that the TRG debated is around combination of insurance contracts. This refers to the application of paragraph 9 in IFRS 17 that calls out for the accounting of a series or a set of insurance contracts which are entered with the same or related counterparty, and that may have achieved or are designed to achieve an overall commercial effect, to be accounted for as a single economic contract, even if legally they are separate contracts. The discussion clearly is a continuation of the issue raised at the February TRG meeting regarding the breakdown of a single contract in its component parts. This effectively looks at the same issue on the other side of the coin by combining them into one economic contract, which is made up of multiple legal contracts. The submission considered a number of factors that could indicate that a set of or series of insurance contracts are in substance a single economic contract. The first is that the contracts are priced as a single risk. The second is that the lapse of one contract changes the rights and obligations of the other contracts. And the third is that measuring the contracts separately would result in one or some of the contracts being onerous, whereas when measured as one single economic contract, that economic contract is profitable. So the key question was when it would be necessary to treat a set of a series of contracts as a whole under IFRS 17, paragraph 9. The staff highlighted 4 key points. The first one is that they departed from the text used in the exposure draft 2013, which talked about contracts entered at the same time with the same counterparty as being still a relevant factor, but not one that in itself would actually allow an insurer to conclude that the combination is required. The same consideration was stated as far as discount is concerned. If you are offering a discount for the same policyholder to buy 2 insurance policies rather than 1, that in itself is not a decisive factor if there are no other indications that the contracts are interdependent with each other. The inability to measure one component without considering the other is actually a far more important consideration, because that would be an indication of interdependency of risks, and the cash flows and contracts may also be lapsing together as a result of that. In other words, contractual rights and obligations should be taken into account in establishing the measurement of the contract on its own and together with the one that are supposed to be combined with. Finally, contractual rights and obligations are different when considered individually and together. This could be an indication of separate contracts designed to achieve an overall effect and should be taken into account when assessing paragraph 9 effects on the contracts sold. The members in the TRG generally agreed with the staff analysis and agreed that no single factor should be considered to be determinative of the effect called out by paragraph 9. But that meant that significant judgment and careful consideration will always be relevant to assess specific facts and circumstances. The good news is that now with the debates between February and May, we now have a comprehensive set of non-binding guidance that can help us understand the application of paragraph 9 and the application of the substance over form principle from the framework, which would potentially cause and require the breakdown of an individual contract in its component parts. The next topic the TRG debated is contrabandary. This, again, is coming back on another topic that was already discussed in the February meeting, but taking now a new perspective. The new perspective is the assessment on what makes the practical ability an insurer has at the renewal date to price the risks arising from a single contract or portfolio in a full way, such that that date becomes the contrabandary for that contract or for that portfolio contracts. The entity is required to consider all the risks that it would consider when underwriting equivalent contracts on the renewal date for the remaining coverage. The paper flagged 2 issues. The first one is whether IFRS 17 requires constraints or limitations other than those arising from the terms of the insurance contract to be considered in assessing the entity's practical ability to reassess and reprice the risk levels of benefits for a particular policyholder or the portfolio of insurance contracts. The second is how to determine the contrabandary of insurance contracts that includes an option to add insurance coverage at a future date. Bearing in mind that this option is not one that can be withdrawn, and once included, the entity is obligated to provide additional coverage if the policyholder exercises the option. So the 2 key questions are effectively on the practical ability and when the commercial considerations may actually influence the limitation of that ability, and second, how do options that add insurance coverage affect the contrabandary. The first issue led the IASB to look at some examples where commercial pressures and reputational risks were actually highlighted as possible limitations of the practical ability. There was also discussion as to whether market competition can be considered a constraint to apply at all times. The staff highlighted that there are some important considerations to bear in mind to conclude on extra contractual limitations of the practical ability to reprice. The first one is that constraints will be irrelevant if they apply both to new and existing policyholders in the same market. Second, legal and regulatory constraints would also be irrelevant if they have no commercial substance. And finally, in analyzing the pricing constraints, the entity must not forget that the practical ability can still be fulfilled entirely if changing the level of benefits still delivers the same economic effect in repricing fully the risks under the contract. On this particular issue, the TRG members agreed with the IASB staff that the constraints on the entity's practical ability to reprice can only exist if they apply solely to existing contracts. Analyzing commercial considerations require, of course, the exercise of judgment in determining when they would result in a constraint. The second issue was more lively debated. This is when the different type of pricing applicable to the embedded option to add insurance coverage play an important part in determining whether they will affect or not the contrabandary. The question then is, if you have agreed upfront the price that this additional coverage can be purchased at a later date, or if you have not agreed such a price, would that create a different outcome in terms of the contrabandary? The paper set out two views. View A is that the additional coverage option is a feature of the insurance contract with the resulting cash flows included in the boundary at initial recognition, and the measurement of the group must reflect the entity's estimate of any policyholder behavior associated with that option, including, and most importantly, the take-up rate. View B looks at the option being outside the contrabandary of the original contract until it is exercised. And when it is exercised, the insurer will have to assess whether these represent a change of the estimates in the cash flows of the original contracts, or whether that event triggers one of the scenarios listed in paragraph 72 and therefore results in a modification which derecognizes the contract prior to the exercise of the option and requires the entity to initially recognize a new contract with the option included on top of the base contract. The staff views were that the original contract includes the additional coverage option unless it is required to be separated from the principles of substance over form debated in the February TRG meeting. The cash flows from the option are within the contractual boundary of the original contract up to the point that the entity is able to fully reprice the whole contract. And if the additional premiums from the option is guaranteed by the entity, then all cash flows are within the contrabandary of the original contract. And for that, the IASB staff noted that there is little doubt. However, if the option's premium is determined only at the time it is exercised by the policyholder, then all the subsequent cash flows, including the ones from the base contract and the option, are outside the original contract boundary if and only if the repricing of the option results in a full repricing of the whole contract. Barring that scenario, the repricing of some of the risks, i.e., for example, the risks associated with the option to add additional coverage, would not represent a contrabandary. And in that case, because the whole contract cannot be repriced, then the cash flows from the option would be within the boundary, even if the repricing is effectively at the discretion of the insurer. TRG members emphasize that the focus of this assessment should be the entity's present substantive obligation, with its end indicating the contrabandary. And they were questioning whether the future coverage option to be outside of the contrabandary when it doesn't contain a present substantive obligation for the entity to insure for this additional coverage at a guaranteed price, even if that repricing option for this additional coverage doesn't result in a full reprice of the whole contract. I was of a different view, and I felt that the ISB staff concluded correctly, and I observed that there are other instances in the standard where the requirements to estimate the own discretion of the insurer is already present, and it has not been challenged by preparers to date. I'm referring, for example, to the discretionary bonuses that has to be estimated for participating contracts, both within the VFA and in the other asset-dependent cash flows, as well as other aspects of discretionary elements of contractual measures that the contracts sold by insurance contracts may have. There was another contrabandary issue. This one was on the insurance contracts held. So from a cedant perspective, the question was how should the boundary of an insurance contract held be determined when the insurer has the right to reprice the remaining coverage prospectively. This goes back to the fact that during the February meeting, the insurance contract held contrabandary was debated, and the conclusion that was documented as an outcome of the debate was that consideration of the cedant's substantive rights to receive services from the insurer and substantive obligations to pay amounts to the insurers must be taken into account together to establish the boundary. And so the presence of a repricing option that is fully controlled by the insurer would only allow the cedant to reject the contract at the new price if and only if the insurer exercises the option to reprice. Given that the two views presented were view A, the cedant has a substantive obligation to pay premiums to their insurer for the full duration of the underlying contracts, and B, the contrabandary should end at the first point at which their insurer has the right to change the premium rates. The staff analyzed, in light of the discussion back in February, that view A is the one that appears to be in line with the spirit and the text of the standard, because in determining the contrabandary, a cedant needs to consider the end of both its substantive rights and substantive obligations. The insurance right to terminate coverage being outside the cedant's control is ignored, and the cedant has an unavoidable obligation to pay premiums continuing for the entire term of the contract held. This means that the cedant will have to reflect its expectations in the fulfillment cash flow measurement of the insurance contract held about the amount and timing of future cash flows, including the probability of the insurer repricing the contract. TRG members agreed that the ISB staff analysis was appropriate and that both substantive rights and obligations should be considered. However, they also noted that the case illustrated in the paper is unlikely to be a common one. There was also a paper that reported back on some implementation challenges that were commented by a number of TRG members in between the first and the second meeting. And these three issues are listed on this page. Let me just take you through each of them in turn. Starting from the first one, the level of aggregation for presentation in the statement of financial position. This is a cardinal presentation requirement for the balance sheet of an insurance company, calling for two numbers to be produced, two numbers only. The first one is insurance groups of insurance contracts that are assets, and the second one is a group of insurance contracts that are liabilities, irrespective of whether they actually belong to the same or different portfolios. The group overall balance would then be further disaggregated in the footnotes, disclosing the element that is the liability for remaining coverage, or the assets that represent the remaining coverage, and that of the liability for incurred claims. This requirement would actually call for a tracking of the actual cash flow movements at the group of insurance contract level, and this means that identification of premiums received and claims incurred may present some significant implementation challenges for some entities that may not conduct their current reporting of cash flow and working capital from insurance contracts at this level of granularity. This will be particularly challenging when there is a requirement to comply with in the footnotes to identify claims incurred at the group of insurance contracts level. And that may be more relevant to non-life insurance contracts, which tend to have a long settlement period. Several TRG members from insurance companies confirmed that if this was to be ranked as one of the issues that would be presenting them with a challenge, they would rank it as one of the top three concerns for implementation. The cost involved in obtaining this information, does not, in the view of these TRG members, justify the benefits. At this point, I have to say that the acknowledgement of the problem has been full, but the indication on the next steps remains vague at the end of the meeting. I'm eagerly awaiting the outcome summary, the official outcome summary of the meeting, to see whether there is any further consideration documented by the ISB staff on the point. But my hopes are not particularly high on this. The second challenge relates to the identification of premium received, particularly relevant for those insurance contracts accounted for using the premium allocation method. As you know, the liability for remaining coverage under the PAA must be accounted for only when collections of premiums take place, and there is a clear prohibition as a result of that requirement to account for premium receivables or accruals. These assets no longer will feature in the financial statements of insurance companies under IFRS 17, and that creates an operational challenge because it breaks the linkage that exists today between the general ledger, premium receivables and accruals, and the credit control systems that insurance companies use to manage the cash flow and the working capital with their policyholders. Again, this is a particularly heavy requirement for general insurance companies and P&C companies that appear to call for a substantial investment in reconciling credit control systems at the group level, whilst today that level of aggregation and granularity is not present. There is also a risk that information in the financial statements may either be lost or become a stimulus for alternative measures to be developed, given that the amount of receivables from insurance contracts appears to be an important piece of information for investors. But that will disappear from the financial statements under IFRS 17. The third and final challenge from implementation that was surveyed during the last 3 months was the treatment of contracts acquired during the settlement period. This is it's a result of a portfolio acquisition. The buyer becomes the company that holds liability for incurred claims, but acquired as a result of receiving consideration from the original insurer. The consideration is likely to produce a CSM, and that CSM will then feed into the insurance service revenue of the acquirer. However, if those claims had remained in the books of the vendor, they would have not produced any revenue because there would have been liabilities subsequent to the expiry of the coverage period. This anomaly of the same post-coverage liability generating revenue in one entity and not in another one appears to generate a risk of potential confusion among investors. And although there was admission from the TRG members that this would create an impact on the P&L of the insurer that acquires the liability for incurred claims, significant doubts were raised as to the merit of recognizing the release of that CSM as part of the insurance service revenue. Finally, paper 7 included all those additional submissions, and there were plenty of submissions in the last quarter, which were not deemed to be complex enough to generate a paper for discussion. Rejection text has been added against each of these papers, and I would encourage you to browse paper 7 and to read the rejection text in the third column to the right to understand why those issues, which are also summarized in the same paper, were not tabled. There is one paper, submission 33, for which some other process other than the TRG will be used to discuss how IFRS 17 may or may not apply to certain types of contracts typically sold by non-insurance entities. In terms of the next steps, the ISB will receive a public debriefing on the TRG at its meeting later this month. The discussion should lead to a decision potentially on the amendments to IFRS 17. We'll see whether we're going to do a flash exposure draft with a short comment period, or whether there will be an accumulation of these first proposed amendments, which the board is likely to approve, plus any other that will come from the next 2 TRG meetings, with a potential exposure draft being published only at the beginning of 2019. The next TRG meeting is going to take place after the summer break on the 26th of September, and the deadline for submission of any issues and comments is the 20th of July 2018. We are about to finalize our summary of the outcomes of the meeting. The IFRS in Focus is due to be published soon, so stay tuned on your favorite Deloitte website, either the dedicated IFRS 17 website or the IS Plus, for the ability to download our summary. And with that, I conclude the presentation for today's webcast, and I would like to request the recording to be stopped and the session for Q&A to be open.